One item that fits that description is alternative minimum tax AMT items. These are found in Box 17 on the Partnership Form 1065 and Box 15 on the S Corp Form 1120S.
Ah, the AMT, another layer of tax complexity.
Indeed. The AMT is basically a separate parallel tax system. It's
Yeah.
designed to ensure that certain higher income taxpayers who might have a lot of deductions or specific types of income under the regular tax rules still pay a minimum amount of tax.
And the K-1 reports items that might trigger this AMT.
Exactly. If you have significant AMT adjustments or preference items reported on your K-1, things like maybe accelerated depreciation differences, certain tax-exempt interest from private activity bonds, incentive stock option adjustments flowing through these could potentially push you into owing AMT.
Which could wipe out some of the regular tax benefits we found.
It could potentially negate or reduce some of the regular tax benefits you've identified elsewhere on your K-1, yes. So this box serves as a crucial warning sign. It's a prompt for careful calculation, ideally with your tax professional, to see if AMT applies to you.
Better know ahead of time than get an unpleasant surprise.
Absolutely. You don't want to find out in April that a great tax benefit you were counting on was effectively erased by the AMT. Planning is key.
You've mentioned it a few times now, but let's stress it again. We see asterisks on the K-1 next to phrases like more than one activity for at-risk purposes, or more than one activity for passive activity purposes, and they always point to an attached statement. Why is it so vital to dig into these see attached statement notes? It feels like the fine print people often skip.
This is perhaps one of the most overlooked yet most critical pieces of practical advice we can give you. Skipping those statements is a huge mistake.
Why? What's in them?
They're often the hidden gems. They contain incredibly detailed information that is absolutely crucial for correctly applying the complex tax rules, especially the at-risk and passive activity limitations we just discussed.
More detail than the main form.
Way more detail. The statement might break down income, losses, and credits by specific business activity if the entity runs multiple lines of business. It might show carryover amounts of suspended losses from prior years. It could explain specific adjustments made to your basis calculation or capital account. It might detail the specific types of other deductions or other income.
So without that detail, I might misapply the rules or miss out on benefits.
Precisely. Without this additional detail, you might miss critical facts needed to accurately calculate and maximize your tax benefits or properly claim things like carryover losses. Think of the K-1 itself as maybe the simplified summary page of your treasure map.
And the attached statements are?
They're the essential, detailed coordinates, the legends, the instructions on how to actually read the map correctly. They tell you how to apply the summarized information to your specific situation.
I can see how overlooking those would be a problem.
Oh, I've seen countless situations where clients overlooked these statements only to realize later